Warren Buffett, known as the Oracle of Omaha, isn't just an investing genius. His life and business lessons are beacons of wisdom for anyone seeking success. Today, we'll explore some of his most valuable advice. Ideas that have stood the test of time and remain incredibly relevant in the world we live in today. One of his fundamental pillars is value investing. It's not about fleeting trends, but about deeply understanding what you're buying and its true potential. Buffett has always emphasized the importance of long-term thinking. Great fortunes aren't built overnight. They require patience, discipline, and consistency. Another key concept is the circle of competence. Invest only in what you deeply understand. Don't venture into unfamiliar territory, no matter how attractive it may seem. This means doing your homework, researching thoroughly. If you can't explain the investment to a 5-year-old, you probably shouldn't make it. It's that simple. Reading is fundamental for Buffett. He dedicates hours each day to reading reports, books, and news. Knowledge is the solid foundation for good financial decisions. He himself says his job primarily consists of reading and thinking, accumulating information to then connect it and make informed decisions. A valuable lesson for all of us. Perhaps his most powerful advice is: the best investment you can make is in yourself. Your earning capacity is your greatest asset. Always remember that. Develop your skills, improve your communication, take care of your health. These investments pay the best dividends, and no one can take them away or tax them. They are yours forever. His famous quote, "Be fearful when others are greedy, and be greedy when others are fearful," is a guide for navigating volatile financial markets. It implies going against the popular current, buying when there's panic in the markets and selling when euphoria is excessive. A strategy that requires discipline and emotional control. Rule number 1. Never lose money. Rule number 2. Never forget rule number 1. It seems simple, but it's the basis of his investment philosophy. This doesn't mean avoiding risk entirely, but managing it intelligently. Understanding the margin of safety in each investment is crucial to protect your initial capital. Look for companies with economic moats or durable competitive advantages, strong brands, patents, network effects, or low production costs that protect them from competition. These barriers make it difficult for competitors to take market share, ensuring sustainable long-term profitability. They are the true crown jewels of business. When partnering or hiring, Buffett looks for 3 qualities: intelligence, energy, and integrity. But he warns that, without the latter, the other 2 will mercilessly destroy you. Integrity is non-negotiable in any aspect. Surround yourself with honest and trustworthy people. Your reputation, like that of a company, is invaluable and very fragile. Buffett says, it takes 20 years to build a reputation and 5 minutes to ruin it. Keep that in mind in every important decision you make in your life. The power of compound interest is the 8th wonder of the world. According to him, letting your earnings generate more earnings over time is a powerful force. The key is to start early and be very patient. Small sums invested consistently can grow exponentially thanks to the magic of compound interest. It's a powerful ally. Patience is an undervalued virtue in the world of investing. Buffett doesn't rush. He waits for the right opportunity, the perfect pitch, like in baseball. The stock market is a device for transferring money from the impatient to the patient. Don't get carried away by short-term noise. Stay calm and keep perspective. Keep things simple in your investments. You don't need complex strategies to succeed. Fundamental principles are usually the most effective and easiest to follow. Buffett avoids investments he doesn't understand, no matter how sophisticated they sound. Clarity and simplicity are allies of good financial decisions. Don't forget that. Price is what you pay. Value is what you get. A crucial distinction. Always aim to buy assets below their real intrinsic value. That's the key. The market can be irrational in the short term, offering opportunities to buy wonderful businesses at bargain prices. You have to know how to identify them and act decisively. Choose your heroes and mentors wisely. You will become what you admire. Buffett had Benjamin Graham as a mentor, and his influence was decisive in his career. Surrounding yourself with people better than you will push you to grow constantly. Learn from the best. Study their successes and, very importantly, their inevitable mistakes too. Buffett admits to having made mistakes, and learning from them is vital. Don't be afraid to make mistakes, but make sure you don't repeat the same ones over and over. Intellectual honesty to recognize an error and correct course is a quality of great investors and leaders. Ego is a bad financial advisor. Concentrate on a few good things. Excessive diversification, or diversification as he sometimes calls it, can dilute your best ideas and also your returns. When you find a great opportunity, an investment with high odds of success and great potential, bet big, but only after thorough and careful analysis. Temperament is more important than intellect in investing. Being able to think independently and not get carried away by market emotions is fundamental. Controlling fear and euphoria, maintaining discipline even when everyone around you is losing their head, is a skill cultivated with time and experience. Buffett is also an example of philanthropy, planning to donate most of his fortune. He believes in giving back to society what he has received from it. This perspective of contribution and legacy is also a valuable lesson. Financial success can have a greater purpose than simply accumulating personal wealth. His preferred investment horizon is forever. He looks for businesses so solid that you could own them for decades without worrying about daily stock market fluctuations. This very long-term vision frees you from the tyranny of quarterly results and allows you to focus on the fundamental and lasting quality of the business. Find a job you deeply love. Buffett says he tap dances his way to work because he thoroughly enjoys what he does. Passion is a powerful engine. If you love your work, it won't feel like a heavy burden. You'll try harder, learn faster, and have a greater chance of achieving mastery in your field. History doesn't repeat itself exactly, but it often rhymes. Studying economic cycles and past crises offers valuable insights for the present and future. Understanding how markets and people reacted in the past better prepares you for future challenges. Historical context is fundamental for an informed investor. These are just a few glimpses of Warren Buffett's vast wisdom, principles that, applied diligently, can transform not only your finances but also your life. Each of these pieces of advice deserves deep reflection. Let's now analyze how we can apply them practically in our daily lives to improve our financial decisions. Let's start with investing in yourself. How does this translate into concrete actions? Dedicate time each week to learning a new skill or deepening an existing one. It could be an online course, reading specialized books, or even attending workshops. The goal is to increase your value in the job market and as a thinking, capable individual. Improving your communication is another key investment. Learn to write clearly, to speak in public, to listen actively. These skills will open countless professional doors for you. Take care of your physical and mental health. A clear mind and a healthy body are fundamental for making good decisions and maintaining the energy needed to achieve your goals. Regarding long-term thinking, set clear financial goals for the next 5, 10, even 20 years. Where do you want to be? What do you need to achieve it? Write these goals down and review them periodically. This will help you stay on course and not get sidetracked by short-term temptations or fears. Learn to ignore daily market noise. Financial news often focuses on momentary volatility, not on the long-term fundamentals of good companies. Actively practice patience. If you've done your homework and trust your investment, give it time to mature. Great rewards are rarely immediate. They always take time. Now, the circle of competence. Take a piece of paper and write down the industries or topics you truly understand well. Be honest with yourself. Don't fool yourself. If your list is short, excellent. It's better to be an expert in a few things than mediocre in many. Focus on investing within that initial circle of deep knowledge. You can gradually expand your circle, but do it with study and dedication. Don't jump into a new sector just because it's trendy or someone recommended it. About the never lose money rule, this relates to the concept of margin of safety. Buy assets for a price significantly below their intrinsic value. This gives you a cushion. If you're slightly off in your valuation, or if things don't go as expected, that margin can protect your initial capital. To estimate intrinsic value, analyze a company's future cash flows, its growth, its debt, and the quality of its management. Look for companies with strong balance sheets, little debt, and a proven track record of profitability. Avoid companies with business models you don't understand or that seem unsustainable. How to be greedy when others are fearful. During crises, when panic grips the market, the prices of good companies can fall unjustifiably. That's the time to buy quality at discount prices, but this requires preparation. Having a list of desirable companies and cash available to invest in them. And conversely, when everyone is euphoric and prices soar without foundation, be cautious. Consider selling or, at least, not buying more at that moment. Emotional discipline is crucial here. Don't get swept away by the herd. Think independently, based on your own analysis and criteria. Keeping it simple is another golden piece of advice. Avoid complex financial products or strategies you don't fully understand. Index funds are a great example of effective simplicity. A simple portfolio, well diversified in solid businesses, often outperforms complicated strategies in the long run. Complexity often only benefits sells it. You don't need to be a math genius. Logic and common sense are your best tools. Buffett himself uses relatively simple math in his analysis. Reading, as we mentioned, is vital. Create a daily habit, not just finance books, but also biographies, history, and quality newspapers. Broaden your perspective. Seek information from diverse and reliable sources. Question what you read and form your own opinion. Don't accept anything blindly, no matter how expert the author may seem. Dedicate time to thinking about what you read. Connect ideas from different fields. The best ideas often arise from the intersection of different disciplines and knowledge. Compound interest. That marvel. To visualize it, use online calculators. Observe how small, regular contributions grow exponentially over time. It's truly amazing. Start investing as soon as possible, even with small amounts. Time is your greatest ally for compound interest to work its magic. Don't underestimate it. Reinvest your dividends and earnings. This accelerates the compounding process. Let your money work for you, generating more money without additional effort. Patience is exercised by not checking your portfolio every day. Set periodic reviews and avoid impulsive reactions to daily movements. Remember the farmer's analogy? Plant the seed, water it, care for it, and patiently wait for the harvest. Good investments follow a similar process. They require their natural time, learning from mistakes. Keep an investment journal. Write down why you made each investment, your expectations, and then the results. Analyze what went right and what went wrong. When you make a mistake, don't beat yourself up, but don't ignore it either. Extract the lesson. Was it an error, an analysis, temperament, or just bad luck? Sharing your mistakes with a mentor or a trusted investing friend can also help you process them and avoid repeating them. Humility is key here, regarding integrity and choosing heroes. Observe how the people you admire behave in difficult situations. Ethics isn't just for good times. It's tested in adversity. Surround yourself with people who inspire you to be better, who are honest and hardworking. Their habits and values will inevitably influence you positively. If you work for a company, observe the integrity of its leaders. Are they transparent? Do they treat their employees and customers? Well, this says a lot about their future sustainability. When evaluating a company to invest in, research the reputation of its management team. Do they have a track record of creating value for shareholders or of self-enrichment? The quality of management is as important as the numbers. A good business in the hands of bad managers can end very badly for investors. Don't be afraid to say no to opportunities that don't convince you or that are outside your circle of competence. Your time and capital are limited. Buffett is famous for his too-hard pile. If an investment is too complicated to understand or analyze, he simply discards it and moves on to the next. Avoid excessive debt, both personally and in the companies you invest in. Debt amplifies gains, but also losses dramatically. A solid financial position gives you flexibility and peace of mind, especially during economic recessions or unexpected crises that may arise along the way. Focus on the free cash flow a company generates. It's the real money left after covering all expenses, which can be used to grow or reward shareholders. Robust and growing free cash flow is a sign of financial health and a business with competitive advantages. It's a key indicator for any investor. Always ask yourself, would I buy the whole company if I had the money? If the answer is no, perhaps you shouldn't buy a single share of that company. This business owner mindset, rather than a stock speculator mindset, will help you make more rational, long-term decisions with better results. A stock's price fluctuates much more than the real value of the underlying business. Learn to differentiate between market noise and business reality. And remember the importance of frugality. Buffett lives modestly despite his immense wealth. Unnecessary waste subtracts capital for investing and growing. Every dollar you don't spend unnecessarily is a dollar that can work for you and your financial future. Spending discipline is always fundamental. These principles, applied consistently, will put you on the right path. It's not about getting rich quickly, but about building wealth solidly and sustainably. Buffett's philosophy is a marathon, not a sprint. It requires discipline, continuous learning, and, above all, the right temperament to navigate the markets. Let's delve into how Buffett analyzes companies. He looks for businesses he understands, with favorable long-term prospects, operated by capable and honest people, and available at an attractive price. Think about this. Would you buy the entire company if you had the funds? If the answer is a resounding yes, and the price is right, then you're on the right track. Buffett reads annual reports with a magnifying glass. He looks for transparency in management's communication, a clear explanation of strategy, and, above all, honesty. Capital allocation is a critical task for management. Do they wisely reinvest earnings back into the business? Do they pay reasonable dividends? Or do they repurchase shares intelligently? A wonderful business, as he calls them, often has strong pricing power. It can raise prices without losing too many customers, protecting itself from inflation. He looks for companies with low capital requirements for growth. This means they generate a lot of free cash flow that doesn't need to be constantly reinvested just to maintain current operations. Buffett prefers standard accounting earnings, not the adjusted figures that companies sometimes present to look better. Accounting reality is important to him. Understanding the balance sheet is vital. A company with too much debt is vulnerable, especially in tough times. He prefers solid, conservative finances that can weather storms. The cash flow statement tells you where the money comes from and where it goes. Free cash flow is king for a value investor. His annual letters to Berkshire Hathaway shareholders are full of wisdom about investing, business, and life. I highly recommend reading them carefully. Dedicate time to understanding the language of business. Accounting. It's the foundation for making informed investment decisions and avoiding costly mistakes in the future. Buffett often says he prefers a wonderful business at a fair price. to a fair business at a wonderful price. The quality of the business is paramount. Patience isn't just passively waiting. It's also the discipline not to act when there's nothing attractive to do. Preserve your capital for clear opportunities. Avoid activity for activity's sake. Many investors feel the need to always be buying or selling. Often, the best thing to do is absolutely nothing. The trap of over-diversification. Owning too many stocks can lead to mediocrity. It's very difficult to closely follow many different businesses with the necessary depth. Instead of diversifying too broadly, concentrate on deeply understanding a few excellent companies. Real conviction comes from deep knowledge, not mere breadth. Loss aversion is a powerful psychological force. People hate losing much more than they enjoy winning. This can lead to poor decisions. Don't sell a good company just because its price has gone up a lot. If the business remains excellent and its future prospects are good, consider holding on. Opportunity cost is a fundamental concept. Every investment must be compared to your next best available alternative, including simply holding cash and waiting patiently. Don't try to predict short-term market movements. No one can do it consistently. Focus on the long-term value of businesses. Simplicity should also extend to your overall financial life. Avoid expensive consumer debt, always live within your means, and automate your savings and investments. Consistency is much more important than perfection. Small, correct steps, taken repeatedly over time, lead to extraordinary and lasting results. Remember that the ultimate goal of investing is to improve your life and have more freedom and options. Don't let money control you or cause you stress. Buffett popularized the allegory of Mr. Market, your emotional partner, who every offers to buy or sell your stake in a business at often illogical prices. You don't have to pay attention to him. You can take advantage of his offers when they are ridiculously low or ignore him when his prices are too high. You are in control of that. He doesn't pay much attention to macroeconomic forecasts. He says economic forecasters exist to make astrologers look good. That's a joke. Focus on the microeconomics of the specific business, its profitability, its competitive position, the quality of its management. The business is what counts, not the forecast. Returning to economic moats, these must be durable. A patent can be a moat, but it expires. A strong brand, like Coca-Cola, can last for generations. Other moats include the network effect, or having sustainably lower production costs over time. When evaluating management, look for leaders who think like owners, not temporary employees, who allocate capital intelligently for long-term benefit. Be wary of management that focuses on value-destroying acquisitions or excessive compensation for themselves, even when the company isn't performing well. The power of focus is immense. Buffett concentrates intensely on the companies he analyzes. He doesn't spread himself thin across hundreds of superficial ideas. Instead, he goes deep. This relates to his famous 20-slot punch card idea. Imagine you can only make 20 investments in your lifetime. You'd be much more selective. This mindset forces you to think very carefully about each decision, to wait for the truly great opportunities, and to invest with conviction when they finally appear. Cultivating the right temperament is a process. It involves developing the ability to think calmly and rationally when fear or greed surrounds you. Learn to see market volatility, not as a risk, but as an opportunity to buy good businesses at lower prices. If you are patient, when Buffett buys a company, his ideal investment horizon is forever. He's not thinking about selling in a few months or even a few years. This very long-term perspective allows him to ignore short-term fluctuations and concentrate on the business's compounding power over many decades. Ethics and integrity are not just for business, but for every aspect of life. Your decisions reflect your character, so always choose wisely. Remember, your reputation is your most valuable asset. Once damaged, it's incredibly difficult to repair. Protect your good name with every action you take. Learn from others. Mistakes. You don't have to make all the mistakes yourself to learn the lessons. History is full of valuable examples. Surround yourself with people who challenge you to be better, who support you, and who share your core values. Good company elevates your own level. Patience and compound interest are two sides of the same coin. One needs the other to unleash its true and amazing power over time. Consider the example of a snowball. It starts small, but as it rolls down a long, snowy hill, it gets bigger and bigger, exponentially. That's how long-term investing with compound interest works. The early years may seem slow, but growth accelerates over the decades. Buffett also emphasizes the importance of communicating clearly. If you can't explain something simply, you probably don't understand it well enough. It's as simple as that. This applies to your investment ideas as well as any other area. Clarity of thought is reflected in clarity of expression, whether spoken or written. Avoid unnecessary jargon. Important financial concepts can and should be explained in language accessible to most people interested in learning. Knowledge is power, but only if applied. It's not enough to read and learn. You must translate that knowledge into concrete actions that improve your situation. Review your beliefs periodically. Are they still valid? As the world changed in a way that requires adjusting your strategy, adaptability is also important here. Adaptability requires an open mind and the willingness to question your own assumptions. The world changes, and investment strategies must also evolve intelligently. This continuous learning process should not be a burden, but a source of enjoyment. Discovering a great company or a new idea can be intellectually stimulating. Buffett talks about the inner scorecard versus the outer scorecard. Live by your own standards, not by what others think of you. This is crucial in investing. If you are guided by popular opinion or market panic, you will make erratic decisions that are detrimental to your wealth. The inner scorecard allows you to remain calm and rational when the world seems to be going crazy. Trust your own analysis and your principles. Avoid envy. Buffett considers it one of the silliest and most counterproductive sins. Envy brings you nothing and only makes you unhappy. Focus on your own progress and your own goals. Constantly comparing yourself to others is a sure recipe for dissatisfaction, no matter how much you achieve. Compound interest doesn't just apply to money, it also applies to good habits. Reading, exercise, learning, small daily improvements accumulate. Simplicity in your lifestyle can free up mental and financial resources. Less clutter, fewer unnecessary expenses, mean more clarity and more capital to invest. Buffett has also said that the most important decision you make is who you marry. A good life partner supports you and shares your values. This idea of long-term relationships extends to business. Seek to associate with people and companies you trust and want to be with for decades. An economic moat is not static. Companies must constantly work to widen and defend their competitive advantages against competitors who never rest. Think of stocks not as pieces of paper that go up and down, but as stakes in real businesses that produce goods, services, and, hopefully, profits. For the know-nothing investor, as he calls them, Buffett consistently recommends low-cost index funds, a simple and effective strategy for most people. This allows you to participate in the overall market growth without needing to be an expert in selecting individual stocks. It's a very sensible option. Remember that time is your most valuable resource, even more so than money. Use it wisely, investing it in activities that enrich you and make you happy. Find intrinsic satisfaction in the investment and learning process. The journey is as important as the final destination, if not more so. Intellectual curiosity is a great driver. Always ask yourself why. Why is this company successful? Why is this sector growing? Dig deeper and learn. The ability to say no is a powerful skill. No to bad investments. No to distractions. No to things that don't align with your goals. Buffett is a master at saying no. He fiercely protects his time and capital, focusing only on the most promising and clear opportunities for him. His ability to concentrate and avoid distractions is legendary. Learn to protect your time and energy for what truly matters in your life and finances. Intellectual honesty is another pillar. Admit when you don't know something. It's better than pretending and making costly mistakes out of pride or vanity. Risk comes from not knowing what you're doing, says Buffett. That's why education and deep understanding are your best defenses against risk. Consider every spending decision as an investment. That daily coffee could be a small share of a stock that grows over time. Choose wisely. The best way to have good ideas is to generate many ideas and then discard the bad ones. Filter rigorously, based on your principles and analysis. Don't be seduced by complexity. The best investments are often in simple, easy to understand businesses, but with solid and durable economics. Choose partners, both in business and in life, whose company you enjoy and whose values you admire. Long-term relationships are built on trust. Look for companies that have a strong and positive corporate culture, where employees are motivated and management is transparent with investors. Buffett invests in brands that people love and trust. That kind of customer loyalty is an incredibly valuable, intangible asset for any business. Often, the best investment opportunities arise when good companies go through temporary problems. The market overreacts, creating an opportunity for the patient investor. Don't get carried away by the noise from experts constantly predicting the market's next move. No one has a functioning crystal ball. Trust your own judgment after thorough research. The market consensus is often wrong at important turning points. Always remember that. Humility is a key virtue for an investor. Recognize that you will make mistakes. The important thing is to learn from them and not let them destroy you financially. Keep your investment expenses low. High commissions and fees can eat up a significant portion of your long-term returns. Efficiency is important. Look for asymmetry. Investments where the potential for gain is much greater than the potential for loss. This is achieved with a good margin of safety. The real game is not beating others, but controlling yourself and your emotions. The market is a mirror of human psychology. Gratitude for what you have helps you maintain perspective. Buffett, despite his wealth, values the simple things in life. Think in terms of decades, not days or months. True wealth creation is a slow and steady process, like watching a strong oak tree grow. Buffett's lessons are not just about money. They are about how to live a rational, ethical, and purposeful life. Universal principles that transcend finance. His focus on long-term value creation contrasts with the short-term mentality that often dominates financial markets and current business decisions. The franchise business concept is powerful. These are companies offering a unique, desirable product or service with no close substitutes and not subject to price regulation. These businesses have enormous pricing power and can increase their earnings even without significant additional capital investments. They are true cash-generating machines. When analyzing management, look for executives who treat shareholders' money as if it were their own, prudently and with a focus on value. Be wary of executives who embark on frequent and costly acquisitions just to grow the empire, often destroying shareholder value in the process. Transparency in communication is a sign of good management. Annual reports should be clear, honest about challenges, and not just celebrate past successes. Buffett often asks, "What would I do if I owned 100% of this business?" This sole-owner perspective guides his investment and allocation decisions. Remember that the market is a voting mechanism in the short term, but a weighing machine in the long term. Fundamental value will eventually be reflected in the price. Market emotions can be irrational, but over time, the true economic weight of the company will determine its real value. Don't try to outsmart the market every day. It's a losing battle. Instead, look for inherently superior companies and hold them for a long time. The circle of competence is not static, but it should only be expanded with genuine and deep learning. Don't rush into areas you only know superficially. Buffett has admitted he was slow to appreciate the potential of some tech companies, but when he did, it was after careful study and understanding their economic moat. The key is sustainable competitive advantage, not technology for its own sake. How does the company use technology to create and maintain a lasting advantage? Regarding debt, Buffett is extremely cautious. Too much debt can sink even a good company if economic conditions unexpectedly turn adverse. On a personal level, avoid consumer debt at all costs. Credit card interest rates can destroy your ability to save and invest in the future. The chains of habit are too light to be felt until they are too heavy to be broken. Build positive financial habits early in your life. Value investing doesn't mean buying cheap stocks of mediocre companies. It means buying excellent companies at reasonable prices, or, ideally, at bargain prices. The difference between a good company and a great company often lies in its ability to generate returns on invested capital, well above average. Look for companies that can reinvest their earnings at high rates of return. This creates a powerful compounding effect within the business itself, increasing its intrinsic value. Buffett's concept of owner earnings is more useful than net accounting profits. It reflects the true cash that an owner can withdraw. It is calculated by taking net income, adding back depreciation, and subtracting the capital expenditures necessary to maintain the business in its current state. This cash flow is what is truly available to the owners, whether for reinvestment, paying dividends, or repurchasing shares. Key management decisions. Be a lifelong learner. The world of business and finance is constantly evolving. Curiosity and a desire to learn are essential for success. Buffett dedicates most of his day to reading and thinking. He considers accumulated knowledge his greatest asset, even more than his considerable personal fortune. You don't need to have an opinion on every stock or every market event. It's perfectly acceptable to say, "I don't know," or "this is too hard for me." The discipline to wait for the perfect pitch in your strike zone is crucial. You don't have to swing at every opportunity that comes along, only the best ones. The market will offer you thousands of opportunities throughout your life. Don't feel pressured to participate in all of them. Selectivity is your friend and ally. The best defense against emotions in investing is to have a solid process and stick to a set of rules and criteria that guide your decisions. Write down your investment philosophy. What kind of investor do you want to be? What are your fundamental principles? This will help you stay on course. Independence of thought is rare and valuable. Most people prefer the comfort of consensus, but great opportunities are often found outside of it. Dare to be a contrarian when your analysis supports it, but don't be a contrarian just for the sake of being contrary. Your position must be based on facts and logic. Consider the pillow test. Can you sleep soundly at night with the investments you hold? If not, you might be taking on too much risk or investing in something you don't understand. Investment success is not about brilliant predictions, but about avoiding big mistakes and letting the power of compound interest do its work over time. Buffett's philanthropy is a reminder that wealth can have a greater purpose. He plans to give most of his fortune back to society. This perspective can influence how we view our own finances, not just as a means for personal consumption, but also as a tool to make a positive impact. Buffett often emphasizes how lucky he was to be born in the right place at the right time. This humility and acknowledgement of external factors is an important lesson. Recognize the role of luck in your own successes and failures. Don't take all the credit or all the blame. Always maintain a balanced perspective. When choosing financial advisors, Look for those who put your interests first and who are transparent about their fees and potential conflicts of interest. Avoid those who promise guaranteed or too good to be true returns. Prudence and healthy skepticism are your allies when making these decisions. The simplicity of Berkshire Hathaway's portfolio, despite its size, is remarkable. It focuses on businesses it understands and in which it has high conviction. Choose quality over quantity. It's better to own a few stakes in truly exceptional companies than a hodgepodge of mediocre, poorly understood investments. Risk management is not about avoiding risk, but about understanding it and ensuring you are being adequately compensated for the risk you take in each investment. A wide margin of safety is the best protection against unforeseen events and miscalculations. Always aim to buy value below its fair price. Investing is a long-term game. Don't be discouraged by short-term setbacks. Keep your sights on your goals several decades out. Warren Buffett's lessons are timeless because they are based on human nature, business, logic, and simple arithmetic. They are beacons of enduring wisdom. Apply these principles with patience and discipline, and you will be building a solid foundation, not only for your financial future, but for a more thoughtful and fulfilling life. Let's think about the importance of options. Buffett often holds large amounts of cash, not because he's pessimistic, but to have dry powder ready when extraordinary opportunities arise. This liquid position allows him to act quickly and decisively when others are forced to sell or are paralyzed by fear. Cash is king in crises. The ability to act when others cannot is a huge competitive advantage in the markets. It requires discipline to hold cash even when it seems unproductive in the short term. Avoid investment fads. What's popular today is often overpriced and may fall out of favor tomorrow. Seek lasting value, not fleeting trends. Buffett doesn't worry about missing out on the next big thing. If he doesn't understand it, or if it doesn't fit his criteria, patience to wait for his opportunity is fundamental. His focus on companies with pricing power is crucial in inflationary environments. If a company can pass on cost increases to customers, it protects its margins. Think about companies whose products or services people continue to buy, even if prices rise a bit. That's a sign of a strong economic moat. The importance of corporate culture is something Buffett emphasizes, though it's hard to quantify. Look for companies where people are proud to work and committed to excellence. A toxic culture or poor management can destroy value, even in a business with good prospects. The human quality within the company is a determining factor. When evaluating a company, try to think like an investigative journalist. What are the tough questions no one is asking? What's hidden beneath the surface? Don't settle for the company's official narrative. Seek independent information. Talk to customers, suppliers, and even former employees if possible. Due diligence goes beyond reading financial reports. It involves truly understanding the business, its competitive environment, and the risks inherent in its operation. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This mantra summarizes his preference for quality. A fair company at a wonderful price might be a good short-term trade, but a wonderful company, even at a price that isn't a steal, can compound value for decades. Buffett also talks about the importance of avoiding ruin risk. Never bet so much on a single idea that a loss takes you out of the game permanently. Even with high conviction, prudent diversification makes sense to protect against the unknown and unpredictable. Don't put all your eggs in one basket. Intellectual integrity means being honest with yourself about your strengths, weaknesses, and the limits of your knowledge. Don't fool yourself into thinking you know more than you actually do. It's better to be approximately right than precisely wrong. Don't get obsessed with complex financial models that give a false sense of precision. Common sense is key. Look for businesses that benefit from long-term secular trends, such as an aging population, the growth of the middle class in emerging markets, or digitalization. But don't invest just in the trend. Invest in the specific companies that are best positioned to capitalize on that trend profitably and sustainably over time. The circle of competence concept also involves understanding your own emotional limitations. Are you prone to panic or euphoria? Know yourself as an investor. If you know you're emotional, create systems and rules that help you maintain discipline, such as stop-loss orders or a written investment plan. Reading biographies of great entrepreneurs and investors can be very instructive. Learn from their triumphs, but also, and perhaps more importantly, from their mistakes and challenges. Financial history is full of bubbles and crises. Studying them helps you recognize patterns and avoid falling into the same traps as others in the past. Buffett often says you don't need to do extraordinary things to get extraordinary results. You just need to do ordinary things consistently and avoid big mistakes. The simplicity of his message is part of his genius. No complex algorithms or secret strategies are needed. Just sound principles applied with discipline and patience. The value of doing nothing is underrated. Sometimes, the best action is to resist the temptation to trade and simply let your good investments compound value. Constant activity in a portfolio often only benefits brokers through commissions. Patience and selective inactivity can be your greatest allies. When it comes to time management, Buffett is ruthless. He delegates almost everything except capital allocation and reading. He focuses on his highest value tasks. Learn to say no to requests that divert you from your priorities. Your time is finite, protected for activities that truly move you closer to your goals. Consider the effect of fees and taxes on your returns. Minimize them by holding investments long-term and choosing efficient investment vehicles. Frequent portfolio turnover not only incurs commissions, but can also trigger short-term capital gains taxes, which are usually higher. The mindset of owning a business, rather than playing stocks fundamentally, changes your perspective. You focus on long-term fundamentals, not daily noise. Ask yourself, would I be happy to own this entire business if the stock market closed for 10 years? If the answer is yes, you probably have a good investment. Honesty and transparency are crucial when communicating with shareholders, something Buffett practices exemplarily in his annual letters. It's a lesson for any leader. Don't try to fool anyone, not even yourself. Facts are stubborn things, and reality eventually asserts itself. It's better to face it clearly from the outset. Seek wisdom from diverse sources, not just the financial world. History, psychology, and philosophy can offer valuable insights for Buffett is known for his love of baseball and uses many analogies from the sport to explain investment concepts, like waiting for the perfect pitch in your strike zone. This ability to communicate complex ideas simply and memorably is one of his great strengths and a reason why his advice resonates so widely. Finally, remember that investing is a means to an end, not an end in itself. The goal is to improve your life, to have more freedom and security. Don't let the pursuit of wealth consume you. Maintain a healthy balance and enjoy the journey, learning and growing as a person along the way. Let's delve into the idea of intrinsic value. It's not an exact figure set in stone, but rather an estimate of the present value of future cash flows a company will generate. This calculation involves making projections about future growth, profit margins, and risks. That's why different analysts can arrive at different intrinsic values for the same company. The key is to be conservative in your estimates. Use realistic or even pessimistic assumptions to create a margin of safety. It's better to underestimate than to overestimate the value. Buffett looks for a significant discount between the market price and his estimate of intrinsic value. The larger the discount, the greater the margin of safety and the potential for profit. Another aspect is the quality of those earnings. Are they recurring and predictable earnings, or do they depend on one-time or cyclical factors? He prefers the former. They are more reliable. Analyze the return on capital employed or the return on invested capital. Great companies consistently generate high returns on the capital they invest. This indicates that management is efficient in allocating capital and that the company has competitive advantages that allow it to earn profits exceeding its cost of capital. Working capital management is also important. A company that efficiently manages its inventories, accounts receivable, and accounts payable frees up valuable cash. Be wary of companies that constantly need large capital investments just to maintain their competitive position without generating real growth in earnings per share. The Lindy effect suggests that the longer a non-perishable thing has existed, the greater its future life expectancy will be. Enduring companies have a track record. Buffett invests in proven businesses with a long history of profitability and adaptation. He doesn't usually bet on new companies or unproven technologies. He prefers certainty. Consider the time tunnel test. If you could go back 10 or 20 years and buy stocks, which ones would you choose knowing what you know today? Look for those qualities. Now, brand power is a formidable economic moat. Strong brands create customer loyalty, allow for premium pricing, and are difficult for competitors to replicate. Think about the trust that certain brands inspire. Consumers are willing to pay more for that trust and familiarity, which translates into sustainable profits. A culture of frugality within a company can also be an advantage. If management is careful with expenses, more money is left for shareholders. Buffett admires managers who operate their businesses as if they were sole, frugal owners, avoiding unnecessary waste and focusing on operational efficiency. Avoid the man with a hammer syndrome. If your only tool is a hammer, everything looks like a nail. Don't apply a single investment strategy to all situations. Be flexible and adapt your approach to the type of company and market conditions, always within your fundamental principles of value and margin of safety. The importance of reading the footnotes in financial reports cannot be overstated. Crucial details about accounting, risks, or litigation are often hidden there. Financial sleuths know that details matter. Don't just stick with the big numbers, dig deeper to understand the company's full story. Buffett has also spoken about the institutional investing in large, stable, and growing economies, like the United States, provides a natural long-term boost. Betting on human ingenuity and general economic progress is a bet that has historically paid off. if done with patience and diversification. The concept of a circle of trust applies to his managers. Buffett trusts the heads of Berkshire's subsidiaries to operate their businesses with autonomy and excellence. Seek to invest in companies where you trust the integrity and competence of the management. It's difficult to achieve good long-term results with bad managers. Temperament to handle volatility is, for Buffett, more important than IQ. Many intelligent people are ruined because they cannot control their emotions in the market. Developing equanimity, the ability to remain calm under pressure, is a skill cultivated through experience, self-awareness, and a solid investment framework. Don't let daily market movements dictate your mood or your investment decisions. Focus on the business fundamentals, which change much more slowly. Value investing often requires going against the crowd, which can be psychologically difficult. Conviction in your own analysis is essential to resist. Consider doing nothing as an active decision. If you don't find attractive opportunities, it's better to wait with cash than to force a mediocre investment. The opportunity cost of a bad investment is not just the loss of capital, but also the time and mental energy you could have dedicated to better ideas. Buffett's philanthropy also teaches about large-scale capital allocation. He seeks philanthropic investments that will generate the greatest possible social impact. This investor mindset can be applied to many areas of life. How you invest your time, your energy, and your resources to achieve the best possible outcomes. The simplicity of his public stock portfolio is deceptive. Behind each choice is a deep understanding of the business and a strong conviction in its future. You don't need hundreds of stocks to build wealth. A few outstanding investments, held for a long time, can do wonders for your net worth. Remember that the market is there to serve you, not to instruct you. Use its fluctuations to your advantage, buying when it offers low prices and being cautious when there is euphoria. The best preparation for market crises is to have a solid investment plan, a well-constructed portfolio, and the emotional strength to stick to your plan. Buffett's lessons are a treasure trove of practical wisdom. Study them, internalize them, and apply them consistently to improve your financial results and your peace of mind. A crucial aspect of Buffett's analysis is assessing the durability of a company's competitive advantage. Is it a moat that widens or shrinks over time? Some companies may have an advantage today, but competitive forces or technological changes can erode it quickly. Look for moats that stand the test of time. Disruptive innovation is a constant threat. That's why Buffett prefers more stable and predictable businesses, even if they may seem less exciting than the latest tech novelties. However, he has shown an ability to adapt, as with his investment in Apple, recognizing the incredible power of its brand and ecosystem. A very potent, modern moat. The key is to understand if the company can maintain its earning power over the long term. This requires a forward-looking view, not just a retrospective analysis of its history. Buffett also pays attention to product integrity. Does the company offer a product or service that truly benefits its customers, and for which they are willing to pay? Companies that deceive or exploit their customers may succeed in the short term, but they rarely build lasting value. Trust is a fundamental business asset. Think of the newspaper test. Would you feel comfortable if your actions and the company's actions were published on the front page of your local newspaper? This encourages ethics. His aversion to excessive debt extends to personal finance. Avoiding bad debt and living below your means is the foundation of financial freedom. The magic of compound interest works both ways. It can build your wealth, or, if you're in debt, it can work against you, increasing your obligations exponentially. That's why paying off high-interest debts like credit card debt is often the best guaranteed investment you can make, with very high returns. Buffett is a proponent of the golden rule. Treat others as you would like to be treated. This applies to business relationships, employees, and shareholders. A culture of respect and fairness within a company contributes to employee morale, customer loyalty, and, ultimately, long-term success. When analyzing an acquisition, Buffett doesn't just look at the numbers. He also assesses whether the acquired company's culture will fit well with Berkshire Hathaway. Cultural integration is a significant challenge in mergers and acquisitions. A bad fit can destroy value, even if the financial logic initially seems sound. The importance of an inner circle of trusted advisors. Buffett has Charlie Munger, whose wisdom and skepticism have been invaluable over decades. Surround yourself with intelligent people who are not afraid to challenge your ideas and point out your blind spots. Critical group thinking is more powerful than individual thinking. Learn to calibrate the opinions of others. Not all opinions carry the same weight. Value more those with a proven track record of good judgment and relevant experience. Reading quarterly and annual reports of companies you don't own is also valuable. It helps you understand different industries and business models, expanding your knowledge. Compare how different companies in the same sector communicate their results and challenges. This can reveal a lot about the quality of their management and their transparency. Opportunity cost should always be on your mind. Before making a new investment, ask yourself if it's the best possible use of your capital at that moment. Sometimes, the best investment is simply to hold cash and patiently wait for a truly exceptional opportunity. rather than settling for something mediocre. Buffett's patience in holding large sums of cash, sometimes for years, until elephant-sized prey appears, is a lesson in discipline and long-term vision. Don't feel pressured to be always invested. The quality of your investments is more important than the amount of time your money is working in the market. His focus on fundamentals contrasts with speculative trading based on price charts or rumors. Buffett invests in businesses, not in stock fluctuations. A price chart tells you where a stock has been, but not necessarily where it's going or what its real value is. Fundamental analysis is deeper. Buffett's ability to think independently is perhaps his most distinctive trait. He is not swayed by the crowd or by passing market fads. Cultivating this independence requires courage, conviction in your own analysis, and the ability to tolerate being at odds with the majority, sometimes for long periods. History is full of examples where the consensus was wrong and independent thinkers were right, but this requires rigorous analytical work, not simple stubbornness. Buffett is also a master of capital allocation within Berkshire Hathaway, deciding where to reinvest the profits generated by its various subsidiaries. This ability to move capital from mature businesses with few growth opportunities to businesses with greater potential is a key driver of value creation at Berkshire. Few CEOs are as good at allocating capital as they are at investing. Buffett excels in both roles, which makes him exceptionally rare and effective. Finally, Buffett's generosity and his commitment to philanthropy through the Giving Pledge underscore that wealth can be a tool for the common good. This legacy of giving back is an integral part of his story and an inspiration for others to consider the broader impact of their financial success. His principles are not just for billionaires. They are applicable to anyone seeking to make smarter financial decisions and build a more secure and prosperous future. Let's consider the importance of simplicity in a company's structure and its operations. Overly complex companies can hide problems or be difficult to manage effectively. Buffett prefers businesses that are fundamentally simple to understand, where revenue streams and profitability drivers are clear and straightforward. This makes analysis easier. Unnecessary complexity often serves to confuse investors or justify higher fees, not to improve results. Clarity is a sign of quality. In his own company, Berkshire Hathaway, the structure is decentralized. He trusts the managers of the subsidiaries to operate their businesses with minimal interference from headquarters. This hands-off model attracts entrepreneurs who have sold their companies to Berkshire, as they can continue to run them autonomously. But with the backing of a patient capitalist, the concept of a fair price for a wonderful company implies not overpaying. Even for quality, there's always a limit to what makes sense to pay. This requires the discipline to walk away if the price becomes too high, even if you greatly admire the business. Patience to wait for a better entry point is key. Buffett has said he'd rather step over a 1-foot bar than try to jump over a 7-foot bar. He looks for investments with high probabilities of success, not risky bets. This doesn't mean avoiding risk entirely, but ensuring that the potential reward amply justifies the risk taken with a wide margin of safety. The importance of understanding market psychology. Markets are driven by fear and greed in the short term. Understanding these patterns can help you avoid mistakes. When everyone is euphoric, be cautious. When everyone is terrified, look for opportunities. This is easier said than done. It requires strong emotional control. The foolish heir test. Could a relatively incompetent heir run this business and still achieve good results? If so, it probably has a very strong economic moat. This underscores the idea that the inherent quality of the business is more important than the brilliance of current management, although good management is always preferable. Buffett also values the predictability of earnings. Companies with stable and predictable revenue streams are easier to value and less risky than those with volatile earnings. This explains his preference for industries like insurance, consumer goods, or utilities, which tend to be less cyclical than others. The importance of share buybacks when done correctly. If a company repurchases its own shares below their intrinsic value, it benefits the remaining shareholders. However, many companies repurchase shares at inflated prices, which destroys value. The key is whether the buyback is done at an attractive price and with surplus capital. The cost of inaction can also be high. If you become paralyzed by fear and don't invest when good opportunities arise, you lose the potential for long-term growth. Balancing patience with decisive action when the right time comes is an art Buffett has perfected over his extensive investment career. His focus on discounted free cash flow as a valuation method is fundamental. How much cash will the company generate for its owners in the future, brought to present value? This is the core of value investing, estimating intrinsic value and buying at a significant discount to that value, regardless of current fads. The ability to learn from mistakes, both one's own and others, is a characteristic of great investors. Don't beat yourself up over mistakes, but make sure you learn the lesson. Buffett has openly discussed his investment mistakes, such as not investing earlier in certain tech companies or buying businesses that didn't turn out as well as he expected. This transparency and humility are refreshing and educational. They show that even the best make mistakes, but what matters is how you respond and what you learn. The circle of competence concept is not an excuse for intellectual laziness. You should continuously strive to learn and, if possible, gradually expand that circle with real knowledge. But don't feel pressured to understand every industry or every company. It's better to be an expert in a few areas than an amateur in many. The patience to let your winners run in your best investments is as important as the discipline to cut losses on bad ones. Don't sell your winners too soon. If a company remains excellent and its prospects are solid, it's often best to hold on and let compound interest continue to work in your favor for many years. The importance of honesty with oneself. Are you investing based on solid analysis, or are you being swayed by emotion, ego, or others' advice? An investment journal where you note your reasons for each decision can help you stay honest and learn from your successes and failures over time. Buffett emphasizes that temperament is more important than intellect. You can be very smart, but if you don't control your emotions, the market will punish you severely. Developing patience, discipline, and independent thinking is ongoing work, but these are the qualities that separate successful long-term investors. Buffett's philanthropy is not an afterthought but an integral part of his life philosophy. He believes that accumulated wealth should be used to benefit society. This focus on purpose beyond personal accumulation can give deeper meaning to your own financial efforts and how you decide to use your resources. Warren Buffett's lessons offer a path to financial sanity in an often chaotic world. They are time-tested principles that have stood the test of time. By applying them, you will not only improve your finances, but also develop clearer thinking, greater discipline, and a wiser perspective on business and life. A less discussed, but implicit concept in Buffett's philosophy is the importance of physical and mental health. For long-term decisions, a clear mind requires a healthy body. Although he doesn't preach it, his longevity and mental acuity at an advanced stage suggest an underlying commitment to personal well-being, necessary to maintain intellectual performance. The ability to withstand market stress and make rational decisions under pressure is also affected by your overall physical and mental state. Take care of your primary asset. Buffett often talks about the ovarian lottery, acknowledging the enormous advantage he had by being born in a country in an era with opportunities. This fosters humility. This perspective helps avoid arrogance and remember that success is not solely due to individual merit, but also to external factors and luck. When analyzing a company, consider its resilience. How would it perform in a severe recession or in the face of an unexpected change in its industry? Look for businesses that can weather storms. Companies with strong balance sheets, little debt, and essential products or services tend to be more resilient than those that are highly leveraged or dependent on discretionary spending. The concept of concentrated investing versus broad diversification. Buffett prefers to concentrate on his best ideas, but this requires deep conviction and thorough analysis. For most investors, sensible diversification is more appropriate, but even within a diversified portfolio, you can lean towards your strongest convictions. The importance of reading between the lines in company reports and management statements. What are they not saying? Is there excessive optimism or a lack of transparency? Develop a fine-tuned nonsense detector. The financial world is full of jargon, empty promises, and misleading narratives. Learn to filter out the noise and focus on the facts. Buffett is also a master in the art of negotiation, evident in many of his major acquisitions. He seeks deals that are fair to both parties but advantageous to Berkshire. This involves understanding the other party's psychology, having patience, and being willing to walk away if the terms are not favorable. Don't fall in love with a deal. His preference for boring businesses is often, the most predictable and profitable long-term companies are not the most exciting or those that grab headlines. Companies that provide essential products or services efficiently and consistently can be cash-generating machines, even if they don't inspire great party conversations. The importance of not interrupting compound interest unnecessarily. Every time you sell a winning investment, you incur taxes and lose the potential for future growth. That's why Buffett prefers to hold his best investments forever, allowing the magic of compound interest to work for decades without tax or commission interruptions. The concept of opportunistic investing. Berkshire Hathaway has often acted as a lender or investor of last resort during financial crises, obtaining very favorable terms. This requires having capital available and the reputation of being a reliable, long-term partner. Crises create opportunities for those who are prepared. Accounting integrity is fundamental. Buffett distrusts companies that use accounting tricks to embellish their results. Look for clear, conservative figures. Learning the basics of accounting is essential for any serious investor. It's the language of business, and without it, you're investing blindly. The value of strategic patience. Sometimes, the market can ignore a company's value for a long time. If your analysis is correct, patience is usually rewarded. Don't be discouraged if a good investment doesn't perform immediately. The market can be irrational in the short term, but fundamental value tends to assert itself over time. Buffett has also highlighted the importance of tax efficiency in investment management. Buying and selling decisions should consider the tax impact. Long-term capital gains often have lower tax rates than short-term ones, which is another argument for holding investments for a long time. The ability to learn from history is crucial. Patterns of human behavior and market cycles tend to repeat, albeit with different nuances each time. Studying past speculative bubbles helps you recognize warning signs when new bubbles form. The importance of a solid, ethical framework. Invest in companies and with people who share your values. You'll sleep better at night and build a legacy you can be proud of. Financial success without integrity is empty. A reputation for honesty and fair play is an invaluable asset built over a lifetime. Finally, remember that Buffett's knowledge is not a rigid set of rules, but a philosophy and a way of thinking about business and investing. Adapt his principles to your own personality, circumstances, and goals, but never lose sight of the fundamentals of value, patience, and rationality that he champions. These pieces of advice, if applied diligently and reflected upon deeply, can transform not only your portfolio but also your approach to decision-making in general. Consider the paradox of skill in investing. As more investors become more sophisticated, it becomes harder to gain a significant edge over the market. This reinforces Buffett's idea that, for many, low-cost index funds are the best option. However, for those willing to do the work, opportunities still exist. Buffett's dedication to intensive reading provides him with an informational advantage. It's not just about reading news, but about deeply understanding companies and their industries. This commitment to continuous learning is a key difference. Knowledge accumulated over time becomes a form of intellectual compound interest. The importance of time allocation. Just as you allocate capital, you must allocate your time to the highest yield activities, both in investing and in life. Buffett is known for having a remarkably clear calendar, allowing him time to think, read, and make important decisions without the pressure of constant meetings. The concept of investing in what you know goes beyond industries. It also refers to understanding the specific business model, how the company makes money, and what its risks are. Don't invest in a black box. If you can't simply explain how a company works and why it's a good investment, you should probably avoid it. Buffett's aversion to detailed long-term financial projections is interesting. He prefers to focus on the quality of the business and its current and foreseeable earning power. Distant projections are inherently uncertain and can give a false sense of precision. It's better to be generally right than precisely wrong. The importance of an ownership culture. In Berkshire's companies, managers are treated as partners and have great autonomy to run their businesses. This attracts and retains entrepreneurial talent, allowing Berkshire to benefit from the experience and drive of many successful business leaders in their respective fields. The value of a good reputation. For a company, a solid reputation attracts customers, talented employees, and business partners, creating a virtuous cycle of success. Building a good reputation takes years of ethical behavior and excellent performance, but it can be quickly destroyed by bad decisions or scandals. It's a fragile asset. The importance of clarity of thought. When making investment decisions, avoid muddled or emotional thinking. Define your criteria and stick to them rigorously. Writing down your investment theses forces you to clarify your thoughts and identify potential flaws in your reasoning before committing capital to an idea. Buffett often speaks of the luck of having good partners. His relationship with Charlie Munger is legendary, built on mutual trust, intellectual respect, and brutal honesty. Seek out mentors and partners who challenge you and complement your strengths. Collaboration can lead to better decisions than isolated individual effort. The patience to do nothing when there are no clear opportunities is a form of active discipline. Avoid the temptation to do something just out of boredom or pressure. Uninvested capital, waiting for the right opportunity, is often more valuable than capital hastily invested in a mediocre or overvalued idea. The importance of understanding the incentives that drive a company's management behavior. Are their incentives aligned with those of long-term shareholders? Compensation plans that reward short-term growth at the expense of long-term profitability or excessive risk-taking are a red flag. The concept of crony capitalism is something Buffett has criticized. Companies should succeed on their merits, not through political favors or connections. Look for companies that compete fairly and transparently in the market, offering real value to their customers, not those that rely on unfair regulatory advantages. A business's adaptability to environmental changes is crucial. Economic moats are not permanent. They must be defended and sometimes reinvented. Companies that invest in research and development, listen to their customers, and are willing to evolve, are more likely to thrive in the long run. The value of simplicity in communication. Buffett's annual letters are a model of clarity and candor, avoiding jargon and explaining complex concepts in an accessible way. This ability to communicate effectively is essential for building trust and ensuring that investors understand the company's philosophy and strategy. Finally, remember that Buffett's goal is not just to accumulate wealth, but also to enjoy the process and live a purposeful life. The game of investing fascinates him. Find joy in learning, analysis, and rationale. This will make the investment journey more rewarding, regardless of the outcomes. These principles, consistently applied, do not guarantee success, but they dramatically increase your odds of making wiser financial decisions and building a more secure future. A wonderful it at a price that offers you a cushion against the unexpected is a prudent and fundamental practice. Buffett has also emphasized the importance of not investing with borrowed money. Leverage amplifies both gains and losses and can lead to ruin. Only use capital you can afford to lose without it drastically affecting your life. Peace of mind is an invaluable asset for a long-term investor. The simplicity test. Can you explain your investment strategy to someone who knows nothing about finance? If not, it might be too complex, or you may not understand it well enough. The best strategies are often simple in concept, though they require discipline and patience in execution. Complexity does not necessarily equate to sophistication. Finally, remember that the goal of investing, according to Buffett, is not just to get rich, but also to enjoy the game and tap dance to work. Find passion in the process of learning and discovery. This will make the journey more rewarding and sustainable over the decades. These principles, distilled from decades of experience and wisdom, are a beacon for navigating the often turbulent seas of investing and business.